Yo, guys, hope you guys are all doing well. I'm going to be making this free video at least once a month, hopefully. Do remind me if I do forget. But, the goals of these videos aren't to say, you know what, I need to start trading the way Adil trades because it's producing sick results, right? That's not the case at all. If you guys pick up any concepts or ideas that you like, feel free to magpie steal it. I'll give you permission, right? But yeah, let's get started straight away. Let me just quickly double check if I'm screwed. Yep, I am. The trade that we're going to be dissecting today is going to be in here, and we're going to be looking at how I basically caught this move over here. And yeah, getting straight into it, I will start off on the higher time frame and then work my way down. So if we go on the monthly, we'll start analyzing the structure and then have a directional bias, okay, aka a story behind why we're even pulling the trigger on the trade. Okay, so we have the first data point, and then we have a low, lower high, lower low. That lower low initiated a new high high. That high high initiated a new lower low. This lower low did not offer a 50% retracement. So what I'm gonna do is I'm gonna move this circle to the next low. Now the three characteristics slash criterias of a pullback for me personally, right? You don't have to use this. Is number one, it needs to retrace 50%. Number two, it needs to tap into a supply zone if we're in a bearish market. And number three, it needs to initiate a new structure point, aka a new lower low in a bearish market. Okay, so just to quickly clean things up, we're gonna put a ray and then put maintains bearishness. As I always say, make sure you guys' charts are looking nice and clean, especially with this visibility tool. You don't want to see your 1 minute markups on the monthly, right? It's just gonna look so ugly, right? Treat your shit like a business, and then you'll be making income like a business, all right? So we have our monthly structure. So we don't really need to look for supply because it's a monthly. It's going to take years and decades. We're probably going to die by the time it comes up by the time it comes up to a supply zone in here. So let's just go straight down to the weekly. From the weekly standpoint, I'm just going to be analyzing structure over here. We have this high, we have this low, we have a high, 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 low, high, high. And then this low didn't initiate a new high, high. So what do? We do nothing. We don't use this or this at all. Okay, so as you can probably tell, we have a new lower low. Doesn't mean we use this high. Okay, this high still remains insignificant. We just carry on with this high, high. So this is the high, high that initiated this new low low. Another way you can look at it is if we're bearish, meaning we made a new low low, you look at the two lows. So you have your low over here, your low over here. What's the highest point that connects these two lows? It's this high over here. So this is the high that maintains bearish structure. If we go above this high, that means price or the market is now bullish on the weekly. Okay, so let me delete all of this junk and then keep it nice and clean once again. Oh, bear with me. And then we'll keep this visible only on the weekly and put maintains bearishness. Cool. Now that it maintains bearishness, we can start looking for supply zones, okay, to formulate a bias. Now, what I can see straight away is we have tons of redistributions, which is an introduction of more sells, meaning there's buys in drawdown, okay, because banks like to buy low, sell high. In order to sell, they need to push price higher to get better selling prices. And then as they sell, they make a shit ton of money on these sells, but then they've also got buys that are in drawdown, okay, which need some sort of mitigation. Or instead of mitigating, what they can do is introduce more sells by redistributing again. Okay, so you just follow the orders. If they come up to mitigate, that's our opportunity to potentially get involved and make money with them. Okay, so we can start marking up supply, but not just any supply. We need to look for supply above the 50% retracement. Why? Not because it's a premium, because it fulfills our first criteria of a pullback. Remember, number one, it needs to retrace 50%. Number two, it needs to tap into supply in a bearish market. Number three, it needs to initiate a new lower low in a bearish market. So from that first criteria alone of retracing 50%, I'm going to be looking for supply zones that fulfills that criteria. Okay, so if I just quickly mark up any supply zones that I see, we have supply zone in here. We'll make this POA, keep it visible on the weekly and below. And then we've got another supply zone in here. Now, I'm not going to go too deep with it and look for supply zones in here and here and here and in here, just because we don't really need to. We're not really dissecting any weekly supply zone trades, sorry, sell trades. And we're not gonna really get there anytime soon either. So let's go straight down to the daily and see what is happening. Let's start looking at structure on the daily. So the daily is a little bit more complicated when it comes to using 50%. Where do you start? The way I like to look at it is who's in control. supply or demand. I can clearly see supply is in control. You have your distribution, you have your redistribution, you have your redistribution. Again, what does redistributions indicate? There's more sales into the market, meaning supply is in full control. So I'm going to be looking for any buys that are in drawdown that need to be mitigated. Okay, so we have this buy area over here, or supply zone, whatever you want to call it, in there. And then we've also got this fat supply zone in here. I'm indicating this low to this high. These are your buy orders that push prices higher. As soon as they got a nice premium price point, that's when they started to sell off. Okay, so these buy orders are in drawdown. This is essentially what I'm going to be waiting for price to mitigate out of. Okay, so in saying that, we can do this. Box this off and just drag this across. Now you can see as price went below this gray box, that means they can start mitigating their orders. Meaning, if we have our buy orders that are in drawdown and then price goes lower, as price comes back into this price level, which is where they open their buy orders, they can start mitigating. Meaning, if price taps into it the slightest bit, this is the amount of orders left. Okay, as opposed to these orders, if that makes any sense. Like before, it would be around here, which is where the orders start. But because price has mitigated it, what you can do is move your supply zone a little bit higher. Okay, so what I'm trying to exemplify in this occasion is price went below this low, and then it came back into it, meaning there's potential orders that's been mitigated. So what you can do is just generalize this supply zone over here like so. Okay, and just to further clarify this, we have real nice imbalance. Okay, so imbalance indicates that there's a real nice supply zone above it or a demand zone below it, depending on what direction of the market you're in. Okay, so it also indicates that there's a shit ton of orders there, and if there's a shit ton of orders that need mitigating, you're gonna get a sick reaction. Okay, so that's that for the daily. This is what maintains structure for me on the daily, because this is the most recent redistribution. Maintains bearishness. Cool, and then we'll make it visit. Yep, only on the daily. Brilliant. And then we just drag this across quick. There we go. So now we can formulate a bias that price can potentially work its way up to here, and then potentially go lower and make a new low. Okay, that's just the anticipation we have to create in a bearish market. Okay, instead of trying to predict, we can just anticipate, and then once we form that bias, we can't just take L's upon L's upon L's on that bias. We can't just say, okay, I'm just going to keep on looking for buys and look for buys and buys and buys until price just decides to come up. That's not how it works. Okay, you have a bias, you need to confirm that bias. Once you confirm that bias, that's when you can start confirming your trades. Okay, so don't just wake up one day and then just start going on the trade view and then go straight to the 15-minute, 1 minute. You need to have a reason as to why you're going onto that time frame. Okay, so just create that story and then go from there. So I've created the story that price could potentially come into here and then go lower. How do I confirm this story? I need to see this lower time frame bearish trend switch into a lower time frame bullish trend. Once I see this switch in trend or transfer from weak to strong, that's when this is a confirmation towards the bias that price can come higher. Okay, so because that's a confirmation, that's the trades that I'm willing to take, or counter trend buys that I'm willing to take, because it confirms the bias. So how do I do this? Let's just quickly go through lower time frame structure. The daily structure is what I class as higher time frame. The hourly, 4 hours / 8 hour, depending on how big your screen is what I class as lower time frame structure. It's very, very difficult to sort of tell you exactly what time frame to utilize to look at certain structure points, especially if you're a new trader, just because you need to understand that you can look at the monthly data or monthly structure on the 1 minute time frame if you have a big enough screen, right? That's just how it is. So it's very difficult to pinpoint which time frame you need to use. So just bear with me. You'll get a feel for it as you start marking up charts and look at certain characteristics, because in order flow, the reason why it's different to structure, the reason why structure differs from order flow is because of the 50% retracement, and order flow doesn't necessarily have to tap into any supply demand. So what does that mean? Sorry to go off tangent, guys. It's just a quick thing to clarify between order flow and structure. Structure, number one, needs to retrace 50%. Number two, taps into supply. I'm just generalizing in a bearish market, by the way. Taps into supply and then creates a new low. Order flow simply just needs to give me a little retracement and then initiate a new structure point. Why? Because order flow doesn't necessarily always have to tap into your previous orders. What order flow does, or what order flow is a jumbled up versions of accumulations, distributions, and redistributions. Again, what is redistribution? An introduction of more cells, meaning price doesn't actually need to mitigate their supply zones. They could just create more cells, right? That's why I don't really get involved with order flow much, but my strategy does allow me to get involved sometimes, and it does work. So, you know, it is what it is. But yeah, let's get into it. Let's go down to the 8 hour, and then we'll have a look at structure from there. So because the pip range is quite large, if we just quickly look at the pip range from this high over here to this low, you can see the pip range is 1,200. That's quite fat of a pip range for a low time frame structure, in my personal opinion, right? For EuroCAD. So what I'm going to do is I'm going to generalize it a little bit lower. So from this low to this high to this lower low, lower high, because number one, retraced 50%, number two, tapped into supply, number three, initiated a new structure point, right? And then we have this low low, then we have this lower high, which again retraced 50%, tapped into supply, made a new structure point. And then we have this lower low, and then we have this lower high. Is it a lower high? I don't know. You tell me. Look at this. Did this tap into supply? No, it didn't. So because it didn't fulfill the second criteria of tapping into supply, I cannot class this as a lower low. So sorry, lower high or a pullback. So I move on to the next one. Did this high tap into supply? No, it didn't. So what do? I move it on to the next low. It's as simple as that. Okay, hopefully you guys understood. If not, just replay it back and then hopefully you get the message. But yeah, you know, guys, if you do have any questions on a serious note, just DM me and then I'll sort it out. Okay, so let me just quickly delete all of these paintbrush tools and then we'll keep it nice and clean. What was it? It was this high, right? This is the high that maintains structure, bearish structure. So maintains bearishness. So we can start looking for supply zones. Okay, so from this high to this low, we just plot on our fib tool, and then we start looking for supply zones above the blue line because it fulfills the first criteria of a pullback. So for me personally, I cannot see any supply zones in here, So I'm going to move straight to around here. Okay, so we have a supply zone in here. I'm not going to go too in depth into marking up supply zones, but you know, just for show, I'll just chuck this on here and then we'll delete this. So now, what do I do now? How did I get into a counter trend buy? Even though we're bearish on the monthly, weekly, daily, and 4 hour, you know, the low time frame structure. I waited for order flow because I needed to confirm the bias that price will come into here and then potentially go lower. So in order to confirm that bias, I need to see a switch in order flow. Once that occurs, that's when I start confirming my trades. Okay, so when I saw this sign of strength over here, specifically the white candles, that's when I looked to the left of it. You can see these are the sell orders that are in drawdown. So if I just quickly box this off, just like so, because these are the sell orders that are in drawdown, as soon as price comes into here and it shows me that transfer from weak to strong hands, aka an accumulation, type 5 accumulation, type 3, head and shoulders, whatever you want to call it. As soon as I see that, that's the first indication that price is potentially going to go higher because, you know, if you see an accumulation in demand, it just indicates that demand is in control and there's a lot of buyers in the market. The second indication is a SOS. Those are the two things that I wait for before pulling the trigger on a trade. Okay, so for me personally, I did enter out of here, I'm pretty sure. Let me just quickly double check. Okay, let me just quickly put a note down so I can remind myself to show you guys at the end of the breakdown. All right, cool, there we go. So I'll quickly go through some screenshots that I took in here, of trades that I took in here, sorry. But we will go through the trade that won, you know, that gave me the big home run. So because price has tapped into this price level already, as you can see, price has tapped into it, meaning the mitigation has already occurred, meaning these orders are the orders that's left behind that could potentially be mitigated. So once price comes into here, I'm going to be waiting for something like this, waiting for this high to be created. As soon as this high is taken out with a nice sign of strength, that's when I look to get involved. Why? Because if you see demand coming to control on the lower time frame, with the context of it tapping out of higher time frame demand zones, what does that indicate? That indicates demand is potentially in control, right? Because if you're tapping into higher time frame demand and it comes into the lower time frames, that's when you know the chain reaction has started. Because in order to get the 4-hour breaker structure, for example, you need to get the seconds breaker structure, then the minutes, then finally the hourly. So we use that chain reaction concept and the concept of fractalization in order to get involved in the markets. Okay, so the price action you see on the monthly is going to be near enough the exact same or similar price action you're going to see on the second time frame. Okay, which obviously it's going to look a little bit different, but you get the point, right? So this is exactly what we're looking for. This right here, this is exactly what we're looking for as price approaches. So let's go down to the 15-minute and then we'll start analyzing it. Cool, there we go. If I go on the 10-minute, just to exemplify this spacing a little bit more, the spacing that I'm referring to, I see a lot of people get confused about this. Let me just quickly bring up my trading plan. I need a bit of spacing, and what I mean by that is this. These lines, by the way, are supposed to represent candlesticks. So yeah, just bear with me. This spacing is exactly what I need in order to confirm this as a high for it to break in order for me to then look for a demand zone to take price higher out of. Okay, hopefully that makes sense. But I'll show you on the candlestick version now. So we have a low, we have a low high, low low. That low low tapped into demand, number one. Number two, it initiated a new high high. Is this coincidence? No. Okay, this is the start of the chain reaction, or this is potentially the start of the chain reaction at the time, right? And then I personally got involved with this 15-minute candle, not because it was just on the 15-minute I found it, because it has multi-time frame. Oh, sorry, let me go on the 15-minute. Bear with me, sorry. There we go. Yeah, because it has multi-time frame confluence. Not only does this 50-minute line up with the 10-minute, which is what I just got off of, it also lines up with the 11. Yep, so we have the 15, 11. There we go, 15, 11, 9, and 10, I'm pretty sure. From what I remember, 10 and 9. Let me just double check. So we have the 10. Do we have the 9? Yeah, so you get the point. We have multi-time frames that line up, multiple different time frames that line up with the same price level. So that's added confluence. Okay, and specifically, I'm trying to play out of these orders right here. Okay, I've got a screenshot as well, which I'll show you guys. Oh, actually, it's over here. I'm pretty sure it's over here. Bear with me. There we go. So these are the screenshots taken at the time of taking it. As you can see, May 5th. There's no BSing around here. And then here's the before. You can see the different time frames that I used, and then I put my stop loss below the low. Why? Because these orders were mitigated by these orders. Were these orders mitigated? No. Okay, hence why I entered out of here, and then I put my stop loss below here, because these orders are all mitigated. The chances of price coming all the way down to here with some, I don't know, seconds time frame orders, very minuscule in comparison to these orders over here. Okay, so that was the idea behind why I put my stop loss over here as opposed to the whole swing low. But if we just chuck in our long position, I'll go ahead and show you guys the targets in regards to the TPs. So going back to the high time frame structure, or low time frame, sorry, in this occasion, what's our first criteria of a pullback? It needs to retrace 50%, right? So from that criteria alone, I'm going to be TPing to that. Okay, so if I just get my fib tool from this high to this low, I want to be TPing to this blue line. Okay, why? Because again, it's the first criteria of my pullback. So why am I going to close out my buy order when all of the three criteria are fulfilled? Number one, needs to retrace 50%. Number two, it needs to tap into supply. Number three, it needs to initiate a new low low. So why am I going to close out my buy once a lower high is confirmed, meaning it's going all the way down here, right? It just doesn't make sense. So what I'm going to do is I'm going to close out of most of my buy positions out at the first criteria. I can hold until the second criteria, which is hold until you tap into a high time frame supply zone. That's totally up to you, right? That's where the freedom comes in. Trading is a fingerprint. Everyone has their own way of trading and dealing with money. Okay, so for me personally, I took out majority of my positions at this blue line because it's 50% of the structure. And that's where I felt most comfortable to take a lot of my money out. This wasn't a monstrous trade, it was 1 to 14, which is okay, I guess. But all in a good day's work, right? I think it took like 3 or 4 days to finish off. So here we got triggered. In terms of risk management, I take a 25% partial at a 1 to 4, and then I take another 25% partial at a new order flow high. So just quickly recap with the order flow. We have low, low, lower high, low, low, lower high, low, low, lower high, low, low, higher high, and then as soon as this is now a confirmed higher low, meaning a new high is put into place, that's when I take a bit more partials out of the market. Okay, now one question that you guys might be asking me is, why are you looking at this low to this lower high as a value retracement? And the thing is, this is order flow. Remember how I was talking about before, the differentiation between lower time frame structure with order flow, it does not need to retrace 50%, and it doesn't really need to tap into any value supply, because this in itself is a redistribution, aka an introduction of more shorts into the market. So instead of coming back up to mitigate these orders, they just decided, you know what, fuck it, let's just get more sell orders into the market. Okay, so that's how order flow works in my head. Okay, now again, just quickly clarify, we all trade our belief systems of how we perceive the market to work, right? So there's no right or wrong. That's why there's so many paradoxes in trading, especially with liquidity. I see it with a lot of traders. You know, when you start studying liquidity, it's like, okay, we have liquidity on this side, but we have liquidity on that side as well. So which one do I take? That's when a lot of traders take matters into their own hands. And then when you take matters into your own hands, that's when a lot of shit goes sideways, right? You don't make that much money. You're probably going to be a break-even trader or maybe even loser. Who knows, right? So that's why you need a trading plan that works well with each other. Okay, all of these confirmations, they need to work well with each other. There cannot be any paradoxes, so that you take matters into your own hands. Okay, that's why I personally like my trading plan a lot, because I know exactly what to do and exactly when to do it. Okay, so getting back into it, you know, I don't want to go too much off on a rant. This trade, if I just quickly play out, hit TP in, let's have a look, in around 4 days. So yeah, all in all, decent trade. 1 to 14. Obviously, it wasn't a full 1 to 14 risk to reward. I mean, 1 to 14% gain on your account balance, because number one, I don't risk 1% per trade. Number two, I also take partials, which dramatically decreases your R to R. Okay, so overall, I probably got around like a 10 to 11 risk reward, which is still decent, right? But yeah, it is what it is. But yeah, you know, guys, that will be it for today's video. Let me know if you have any questions. You know, if there's any ideas or concepts that you really like, take it. And yeah, hopefully I'll see you guys grow as a trader. And yeah, I guess I'll see you guys next month. Take care.